What are leading, lagging, and coincident indicators for commodities? Imagine trying to predict the weather without a forecast. It would be tough to plan your day, right? The same idea applies to understanding how commodities move in the market. Knowing which economic signals come early, which confirm trends, and which show the current state can help you make smarter investment choices. Leading indicators are like the early warning signs. They hint at what might happen in the future. For commodities, these include the Purchasing Managers' Index, which surveys manufacturing leaders about their expectations. If the index rises, it suggests factories are busy, and demand for metals, energy, and raw materials could grow. Building permits and housing starts are also key. When more permits are issued, it signals upcoming construction, boosting demand for lumber, steel, and other building supplies. Stock market trends act as another leading indicator. When stocks go up, it often means investors feel confident about the economy. That confidence can lead to increased consumption of commodities like oil, copper, and agricultural products. Commodity futures prices are also useful. If futures prices are higher than current spot prices, it suggests traders expect demand to increase or supply to tighten in the future. Central bank policies matter too. When interest rates are cut, borrowing becomes cheaper, encouraging spending and investment, which can push commodity prices higher ahead of actual economic growth. Lagging indicators come after the fact. They confirm whether a trend has already started. For example, the unemployment rate is a classic lagging indicator. When unemployment rises, it confirms the economy is slowing down, which usually means less demand for commodities. Corporate earnings reports from industries like mining, energy, and agriculture also serve as confirmation. If these companies report weaker profits, it signals reduced demand. The Consumer Price Index, which tracks past inflation, can also confirm if commodities are acting as an inflation hedge. High inventories of oil or metals show that supply exceeds demand, confirming a slowdown or oversupply. Coincident indicators move in sync with the economy. They give a real-time picture of current conditions. Industrial production measures how much factories, mines, and utilities are producing now. When output increases, demand for energy and raw materials rises too. Retail sales reflected current consumer spending, which directly impacts agricultural products, energy, and manufactured goods. Gross domestic product, or GDP, shows the overall economic output and correlates closely with commodity demand. Current spot prices for commodities like crude oil, copper, or wheat are also coincident indicators. They reveal the immediate supply and demand situation, helping investors see what is happening right now. Using these indicators together helps investors see the full picture. Leading indicators can suggest what might happen next, lagging indicators confirm trends, and coincident indicators show what is happening at this moment. This mix allows for better timing and risk management in commodity investing. Because commodities respond quickly to news, weather, and geopolitical events, keeping an eye on all three types of indicators helps you stay ahead of the market. In simple terms, think of leading indicators as your forecast, lagging indicators as your confirmation, and coincident indicators as your current weather report. Combining all three gives you a clearer view of how commodities are likely to perform in relation to economic growth.